Hello there, hello there. This video is welcome to another Peak Financial Planning presentation. This is one of two videos I'm making targeted at explaining what working with a financial planner actually looks like. So you're either in two buckets, and this applies to everybody. You're either in the savings phase of your financial life, meaning building wealth, accumulating assets intended for the distribution later on in life. That's the saving phase. Or you're in the distribution phase, which is basically the point at which you start planning to take assets out or take income from the assets you've built up. This presentation is what it looks like to work with a financial planner during the savings or accumulation phase of your financial life. I'm going to make a second video that will be posted later about the other phase, which is usually targeted towards the 55 plus age range, where you're starting to plan for when do I retire, how do I take income, things like that. So again, moving back into the lens of who this is applied for, this is for savers. So let's set the stage. The idea here is, what do I do as a financial planner with someone to help them achieve their financial goals while they're in the savings phase? Let's set the stage. First stage here is what you call the break-even scenario when it comes to income and expenses and saving. Many people's income and expenses look like this. You have a $100,000 after-tax income, so you spend $100,000, no savings. No debt, no savings, okay place to be. A lot of people are in this position. Second stage, we have the accumulating debt scenario. In this place, your expenses are $100,000, but your income is $85,000. And so you have this bubble here called the gap, and the gap of $15,000 a year ends up being debt accumulation. And most people these days look something like this, even if the numbers are slightly changed. Where you want to be, and where I want to help someone work towards as a financial planner and advisor, is the saver and super saver scenario. And this is where very few people's income and expenses are, but where you want to be. And this is basically the inverse. It's when you have after-tax income of $100,000, but you spend $85,000, so you've got $15,000 that can go towards savings goals. Now, this doesn't mean this is the only thing we're working on, but my philosophy is why pay attention, and I'm going to demonstrate this in this presentation. Why pay attention to investments at the expense of this when this is far more impactful? Savings is way, way more impactful than seeking out an extra 1-2% of yield on a smaller amount of savable money. So when it comes to that, my philosophy is I have two primary pre-retirement goals for people. The first is to increase your savings rate as much as possible, because this creates the most investable dollars, and the more investable dollars you have, the less risk you need to take when it comes to investing, meaning you can have more comfort and consistency with your investing. And the second goal is to invest by hitting singles and doubles, lower risk, moderate reward, rather than swinging for the fences and taking high risk but high reward bets. The reason to do this is if you increase your savings rate and create more investable dollars, you buy yourself the privilege of taking lower risk bets and therefore sleeping better at night while still achieving your financial goals. Most people that do the high risk, high reward, swing for the fences type of behavior will not succeed. Probability just says most of you, if you say that because I've seen other people do that, it can happen for me, you will not succeed. So this whole presentation is built on the premise that we want to increase your savings rate because it will always be the fastest path to wealth. And it's in your control in a way that changing the rate of return you get on an investment is not. You directly control your savings rate. I'm going to demonstrate that. No one is in direct or perfect control of your rate of return on an investment. Let's talk numbers so you can see why savings rate is so much more powerful than rate of return. Okay, so I'm going to set the stage here again. I'm going to show you three scenarios, but this first scenario is three assumptions. The first is that this individual starts with $100,000 that's invested. The second is that they get a 7% growth rate over 10 years. And then the third is that they're saving $5,000 per year. This is intentionally simple just to illustrate the difference in power between savings and growth. So we're really focusing on this green bubble column here. If you start with 100K and you do these things, you save $5,000 a year and invest at 7%, you will end with $265,000 or $266,000. Okay, what happens if you increase your growth rate to 8%? Well, that same $100,000, if the only thing you change is you get 1% better return for 10 years, you'll increase that ending value to $288,000, which is a roughly $23,000 increase. And then if you take a third scenario and you increase your growth rate to 9%, so now you have a net 2% growth, you will end your 10 years with a value of $312,000, which is roughly $50,000 difference. It's like 46 or 47,000. Okay, not bad. What's the alternative? All right, this is a savings scenario where we focus on savings instead of growth rate. This first scenario is exactly the same as on the other slide. Invest $100,000, save $5,000 a year, growth rate of 7% each year. You end 10 years with the same portfolio value as the first scenario in the last slide. What happens if you increase your savings rate here in this middle column to $10,000 a year? No change to growth rate. Your ending 10-year portfolio value is $334,000, which is almost $70,000 higher than your first scenario. And then your third is if you increase your savings rate to $20,000 a year, and you don't change anything else. Now your portfolio value ends at $473,000, which is it's over $200,000 higher than your first scenario. Okay, let's look at them side by side. So what do the slides tell us? Well, in the first scenario, if you squeezed 2% of growth out of this portfolio, and that's very, very difficult, and you could never guarantee it, you will, through that, obtain a $47,000 delta. You'll basically increase your ending portfolio value by $47,000 if you could guarantee that you could go from 7% to 9% for 10 years. Again, no change to your savings rate. The second scenario, if you go from $5,000 a year saved to $20,000 a year saved, you will increase your ending portfolio value by $207,000. That's 5 times higher, roughly, just under 5 times higher, the alternative scenario. Let's put them side by side just again so you can see. The first scenario, you get to 9% growth in the best case. In the second scenario, you do the thing you actually can control, which is you increase your savings rate to 20 grand a year. You'll end with $160,000 more on the right side scenario where you increase your savings rate but don't change your growth rate. Then if you go and hope that you change your growth rate but never change your savings rate. So after illustrating that, it's incontrovertible to me that that's the place to focus, which is savings rate. So that's what I do with clients. And so the question is, how do we increase your savings rate as much as possible as part of one of the many pillars that we focus on in a financial plan? But this is the central pillar around which other decisions are made. You can do it in 3 ways. You can increase income, you can decrease expenses, you can also learn to keep more of your money, which basically means being smarter with tax planning, things like that. This slide shows a grid of a bunch of different tools that financial advisors or planners will use to help their clients achieve these outcomes. Some of them are for employed people, some of them are for self-employed people. I'm not going to go through them, but what I will focus on is this column in the middle, which is decreasing expenses, which is these are 3 things that most people don't do that you have direct control of that will dictate the outcomes of your financial life. Regular bookkeeping tells you how much you're spending, and I'm actually going to go over these on the next slide, so let's skip ahead. But anyways, you have all those tools, and the idea here for me is it all starts with bookkeeping. You have to produce a detailed expense worksheet and a system to track that spending, and then you need to check on it regularly. And then you need a plan for surprises because it's those one-time annual expenses or surprise expenses that you have no funds set aside for that are what are called plan killers. And then you set up sinking funds, which are the insurance, they're savings accounts where you set aside money for one-time expenses that you know or believe you'll have in the future. And they act as a self-insurance policy against surprises. And then you set up a money tree and you automate and delegate your savings and investing. And I've done a whole video on the money tree and I'll link that here. I'm not going to go through the money tree other than to show it. It's basically a flow chart that helps you document your income, your expenses, and your savings goals. And I'll show it on the screen here so that you just have a central location where everything is documented and visible for those that are more visual. Okay, once you've done this, once you've done those 5 steps and you've created the biggest surplus that you can, the biggest savings rate that you can, now we can decide how to allocate your surplus. So you got to take that pie and divide it up between different goals. And you got to start by identifying the goals first. So retirement savings, kids fund, house fund, slush fund, whatever, but we got to start by figuring those things out. And then once you have your goals and your savings rate, you can begin making investment decisions in the order that I'm going to show on the screen, which is start by selecting and opening the right account types. Second, fund accounts in the right order. Third, evaluate how much risk you need to take in order to achieve your goals. And again, just like we talked about earlier, higher savings rate buys you the cushion and comfort of needing to take less risk in order to achieve your financial goals. Take as much risk as is necessary, not more. That's the idea. If you're taking more risk, but you don't need to, it's an evidence of poor planning. The 4th step here is build a model that's based on your risk level. And then the fifth one is research the individual investments that will comprise the model. So the model is at a global level. What percentage of my portfolio should go into risky investments? What should go into less risky investments? And what should go into the lowest risk investments? Then you have to research the actual investments that would make up each of those tranches or tiers. And then finally, at the end, you go out and you purchase the appropriate investments in the appropriate accounts. I show it in this order because most people do things in the opposite order, or they jumble this whole thing together and there's no cohesive plan. They're doing things in the wrong ways. And oftentimes they make mistakes. To summarize, this is the pillar of saver accumulator financial planning. You do have other things that you will attend to, including estate planning, like having a will or a trust for your family, or setting up, learning how to gift in a tax advantaged way for your family, or maybe taking care of equity compensation if you work for a tech company, or maybe you have a closely held business and you need to plan for how to optimize and secure your business long term. Those are all things that go along with it. But you have to also focus on this pillar. And the idea here is you treat your finances like a garden. Do three things. Harvest your bounty. If you have a garden and you plant fruit trees and you don't harvest the bounty, it just rots. It falls to the ground and rots, creates a problem. So you should take the profits, which is harvest the fruit, and then redistribute those gains to plant other plants, place other seeds for future harvest. The second thing here is prune the garden. You wouldn't let your garden accumulate weeds everywhere. And if you did, you wouldn't be very proud of that garden. So you got to cut your losers, pull the weeds. If you have bad investments, that's okay. That everybody does. Don't let them ride. Cut the losers. Third, it's a responsibility. Finances are a responsibility, just like planting a garden is. If you start the garden, see it through. Don't leave it. Don't abandon it once you planted it. No one's proud of that. Same thing with your finances. And then fourth, build something to be proud of. When you plant a great garden that looks beautiful and has amazing, bountiful harvest that your family and friends can look at and say, wow, in that garden, I can see the hard work, the education, and the high standard you've set for yourself when tending that garden. The same is for your finances. When you build a great financial system, you sleep well at night because you look at it and you're like, I've covered all my bases. I don't have to worry about where this is going to go. The recommendation I make here is always work with a professional, because mistakes are costly, and I can't tell you how many times I get calls after someone has made a mistake because they didn't know the rules or they did something impulsively. You can't get do-overs. You cannot call the government after you've made an improper distribution from an account, or rolled over an account improperly once you separate from an employer, or open the wrong account type and fund it incorrectly. The government's not giving you your money back. You make a mistake, you pay the price. Same thing if you make a bad investment. If you invest, you can't call the company, and you didn't do it in the right way, you cannot call the company and say, hey, can I petition you for my money back? It's done. You suffer the consequences of the decisions you make when you're uninformed. So seek out professional. The best way to do that is to seek out a fee-only fiduciary financial planner or advisor. They're kind of the same thing. The fee-only fiduciary speaks to how the advisor is paid and whose best interest they have to serve. I'll flash a guide on the screen that I've written about this exact thing that helps you understand what are the different types of advisors, why is it important to know how they're paid, so that you can determine whether you're going to get the best quality advice and a qualified professional who's dealt with the scenarios that you need in your life. Last but not least, I have a free training video that you can watch that talks about those subjects and all the things we've talked about today. It's titled How to Increase Your Retirement Income by Up to 30% and Avoid Running Out of Money. The idea is, through proper planning as a young person, or even as you approach retirement, you can keep more of the money you've made and use more of that money rather than giving it away through costly mistakes, bad tax planning, and things like that. And the video will also answer questions about how to understand the financial advisor space. What types of advisors should you work with? What types of questions should you ask advisors? So I highly recommend going there. This link up here on the top, app.thepeakfp.com/free training, is where you can watch the free video. Obviously, if you have questions, you can submit them in the comments below. You can also reach out to me by email. You can go to my website and find that there. I hope you found this video helpful. If you have questions about what other financial planning topics people use, or tools that financial planners or advisors use when working with clients, I'm more than happy to address them. Just a reminder that this is the pillar, but the financial advisor and planner handles all the other advice topics around this as well, including investments and estate planning and tax planning and insurance planning. But finding the right advisor is the key to the linchpin around which all of that works. Thank you for your time and attention. If you have suggestions for other videos, let me know. As I said, if you're in that second cohort of distributors or someone who's planning to take distributions from their portfolio over the next 5-7 years and beyond, the second video will attend to that and speak to that. So again, thank you and talk soon.